You have to have an economy that supports a minimal viable standard of labor. That person, that laborer, should be able to support themselves with the sweat of their brow. They should be able to support a family of 4 if you want a functional society. They should be able to support a spouse and 2 children, 2.1 children technically if we want to be able to grow, and we want to be able to grow. So the minute somebody else can print your dollar, I trade that person, you break bricks on the side of the road, and I give you value in exchange. Your hour for this value. Tomorrow, if the value is stable, that person made an adequate trade for the same amount of labor that they expelled the day before. But that's not the environment that we're in.
Hello and welcome to the Perpetual Traffic podcast.
The show where we talk about business, marketing, and geriatric hot yoga.
I'm Ralph Burns. I'm the founder of Tier 11.
I'm Kasim, Aslam, the co-founder of the Driven Mastermind.
And we are so glad you joined us today. If geriatric hot yoga is your thing, this is not your show.
We'd also love for you to come hang out with us in our Telegram group, perpetualtraffic.com/Telegram.
Yep. Now, enough of that nonsense. Let's get into today's show. Today's show, we're going to go, and I know this is another business cliche. I just looked up the top 25 business cliches of all time, and this is right in there. We're going to go 30,000 foot view on the economy today, because Kasim and I are seeing two very different things. And if you're marketing in today's environment, the chances are you're probably a marketing person, or you're a VP of marketing, or you are a CEO. The economy is something that's always in the back of your mind. It might not be the first thing that you think about when you wake up in the morning, but Kasim has some interesting thoughts on this, and I have the complete and pretty much diametrically opposite thoughts based upon what we're seeing in our business. And the interesting part of this is that when you're a marketing agency, you're a line item, right? And the line item oftentimes is the first thing that a lot of people will look at and cut. Is, I'm going to cut my advertising, I'm going to cut my marketing, I'm going to cut my PR, I'm going to cut my social, I'm going to cut. A lot of those line items are some of the first things that people cut when they're afraid or they're uncertain about where the economy is going, or if they start to see warning signs in their business, like, clouds appearing on the horizon. So I think we're actually, uniquely qualified to discuss this. And, like stuff, we were watching 60 Minutes, me and my wife, the other night, which we never really do, but we watched 60 Minutes. It was about like these cargo ships that are now being diverted from the Suez Canal because of this group that is, basically, pirating these ships in this tiny little narrow strait in the Suez Canal, and now they're rerouting these ships all the way around the not past the Horn of Africa, below Africa, and then to Europe. And we're actually seeing the effect of that of some of our e-commerce businesses in delays, and
that has to be insane.
It's
think about
it's insane. It's like it adds millions and millions, if not billions of dollars to transportation costs, and it affects the entire supply chain. So something like that, like we see that in our business with some of our larger e-com customers, that, instead of it being delivered in 5 to 6 business days, now it's 8 to 10, or maybe it's 2 to 3 weeks. It's like all that sort of stuff changes. So global economics actually does affect you in marketing. It does affect you in your business, whether you like it or not. And I think we're sort of in the tip of the spear in a lot of cases as marketing agencies, because we see it first. Like we're the canary in the coal mine in a lot of ways.
It's funny because I think that we're the front end. If you look at it just in the most basic terms, the marketing agency, I have 200 some odd clients. So I get to see 200 various industries, 200 different geographic regions, reaches, customer bases, et cetera. I think the back end of that are CPAs. I think if you really want to know what's going on, if you want the lead indicator, look at the marketing agencies. If you want the lag indicator, look at the financial firms. Because the financial firms have more or less the same thing, and they get to see all the data on the back end. And so between those two, you have like these, it's anecdotal, obviously, but it's not inadequate anecdotes. Like anecdotal evidence is still evidence, right? It's not properly filtered through the scientific method, but it's a lot better than licking your finger and putting it in the air. It's like, okay, I have $100 million in ad spend, and I am seeing this. That's relevant. And the thing that I'm seeing, dude, I think we are in, and I don't want to call it a recession because that feels like the wrong word, but it's the closest thing I've got. I think we're in something like a phantom recession. I keep seeing cancellations from high performing accounts, clients who have been crushing it for years suddenly not able to fulfill on orders, people bringing it, quote, in-house as they batten down the hatches. I talked to a gentleman yesterday who does nothing but M&A for small agencies. He told me that he did due diligence on an agency that's a multi-year agency, not a brand new agency, that lost 20% of their client base last month. Last month, 20% of their clients were gone. When I sold my agency, I had 185 some odd recurring official clients, not including consultation clients or clients under observation. Since then, we've lost 50. Now, the 50 that we've lost were all small. What's really interesting is our ad spend under management has more or less maintained the same, because as we're losing small ones, we're bringing bigger ones on. But I think that that's also an indication. It feels like medium and big businesses are scaling up, growing up, grouping up, acquiring, and small businesses are getting nailed to the wall. And what's sad is it's probably better for our client base that the diversification mix begins to veer up the way that it's doing, because we're getting people with bigger spends and, bigger opportunities. But I worry about, dude, that small base, that was my bread and butter for a long, long, long time.
Yeah.
And it's weird that nobody's talking about this. And again, I realize it's anecdotal, and I'm not trying to sound like Chicken Little. And I know that you love to make fun of me because of how much of a freaking conspiracy theorist I am. But dude,
A bit.
I keep hearing people talking about the same thing that I'm seeing, but I see no headlines.
Mhm.
Like we have one of our, and this isn't even a small client, one of our mutual clients, Ralph, is selling $5 million in product, and they can only fulfill on 4. 20% of their product is going unfulfilled at the moment. And they're having a hard time, and they're not a small client. So there's just something weird going on in the market. And I'm not telling you it could be like dead cat bounce from COVID, the ripple effect of all the supply chain issues. We did 40% of the money that exists in the world was printed in the last 2.5 years. So, the inflationary environment that we're seeing, but there's just something happening that nobody's, either the measurement instruments we have aren't adequate to measure whatever it is that's happening, or we're not talking about it. That's my thesis and my theory. And if you're a Perpetual Traffic listener and you have a theory on this one way or the other, if you think I'm crazy or you think I'm absolutely right and a brilliant genius, and you want to come back me against Ralph, who's about to argue with me, you can go to our Telegram thread where we can all talk together and digitally in person, perpetualtraffic.com/telegram.
Yeah, I think I actually think, like, if you read, I read a fair amount of financial news, and I am not seeing anything that's indicating this, but that doesn't necessarily mean that it's right. And in a certain subset of your customers, you are seeing it. And I do think, like in my, somewhat long-winded intro about marketing agencies and the fact that we are the canary in the coal mine. If you don't know what that expression is, I don't think that's an overused business phrase, by the way, because I do think it's an early indicator. We're the litmus test for, like, I always look at like the economy in general, like the tech sector. I look at the semiconductors. How are the semiconductors doing? Like, they're the lead indicator of how tech is going. And right now they're on fire. Especially,
Isn't a lot of that because of Taiwan? Like, we're just about to lose all of the, high-end manufacturing, and so people are trying to snap up as much of it as they can. And I'm talking on a topic that I don't know or understand, but that's my scratch the surface understanding of maybe what's happening there.
yeah, I see it in a couple of different ways. Like, my son is actually applying to semiconductor companies, and he is getting flooded with offers, which is great as a dad, some of which he doesn't want. But I think also on the semiconductor side, for the very high end, ultra fast GPUs, which are powering AI, like NVIDIA, is the number one stock in the last year. Just because, their growth is triple digits every single quarter. They just announced their earnings last week, and it's like the CEO's wealth went up by like $5 billion in a day. It's crazy. So there's certain sectors of the market, and I look at semiconductors as a leading indicator for tech. Rightly or wrongly, I just do. But I also look at marketing and what we're seeing as a leading indicator for business in general in a lot of ways. And it's a counterintuitive argument, because a lot of people say, oh, that's so arrogant for you to say that. Well, Name me another business that is basically disposable income to a certain degree and is always cut back when there are hard times. And it's typically it's marketing. I have friends in the PR industry. They're even worse. Like that's the first thing that gets cut.
Oh, dude.
No more PR,
Yeah.
done.
Yeah.
But we are seeing a huge influx of the exact opposite of what you're seeing. We're seeing, middle market, upper middle market businesses that are 7, 8 figures wanting to get to 9 figures, making a shift and coming to an agency like ours with, staff of 100 plus people, with a lot of different ways in which we can help expand and grow. And I'm not turning this into a tier 11 sales pitch. The point is like, we're seeing migrations from smaller agencies over to us because we know how to scale and grow through a lot of things that we talk about on the podcast and through our socials and everything else. It's just a different way of doing things. So we are seeing that. Now, is that sustainable? I don't know. Like we tend to, if I sort of look at the market in general, there is on the bottom, I don't think I've ever seen an image of this. Like we did this in our leadership meeting 2 weeks ago. There's the small market. There's like the mom and pop stores. There's a lot of those. It'd be interesting to see like what percentage of your clients are in that market. And then there's sort of this
80%.
Lower middle, interesting. Okay.
Yeah.
There's this lower middle market, which is, 7 figures, maybe mid 7 figures in that range. And then there's this upper middle market. I remember talking to Neil Patel about this. The upper middle market for us is, high 7 figures to hundreds of millions in revenue. And then above that is enterprise.
So I would characterize mom and pop as anything sub 5 million. So 80% of my clients are sub 5 million in gross.
Sub 5 million. Okay.
Yeah. That seems to be the line. And what's interesting too, is that's the line of demarcation before you really need infrastructure to scale.
Yeah. It's a lot of, it's a place where a lot of businesses stall out.
Or intentionally stop. Like, hey, I'm good here, and those are the businesses that I'm talking about in a lot of instances where I'm just seeing like this really strange environment. But dude, I hear what you're saying on the enterprise level. I think that these don't have to be mutually exclusive. As a matter of fact, one could lead to the other. If enterprise is gobbling up everything, and then what I'm seeing on my end is just the fallout that small businesses are experiencing, that could be the kind of domino effect that's happening here. I don't know.
I don't know either. I see what I see coming in. I just got off the phone with a business owner where he's like, I want to get this thing to 9 figures, and we're at 8 right now, and we need your help to do it. So like he's in the I won't say exactly what industry he's in, but he's in the e-commerce space, serving 25 to 45-year-old females, fashion, beauty, that kind of thing.
This is the hardest, most competitive demographic in the world.
Super hard.
Expendable income. Yeah.
Yeah. But the point is that we're seeing a lot of that. Hey, we've hit this wall and then we want to get to the next stage, and because we've grown and we're doing well, but we can do better. Like in most cases, that's usually the types of people that we're talking to, and the ones that we tend to get the most, the most juice from. Like we really do love doing that. And then there's the ones that are basically just starting out. We don't have as many of those as we call those type A clients. Like they're, the initial, hey, I'm just getting started, but I've got venture capital. I've got, maybe some private equity, or maybe I've got like some angel investors, and I have this idea, and we'll talk to those folks. Like if they don't have the money for it, it's hard for us to implement anything on the marketing side. And then there's the ones who are like, all right, well, I'm doing pretty well right now. I just need a change of look. Maybe I'm spending, $50, $60, $70,000 a month. I need to get to that next level, $30, $40, $50,000 a month. I need to get to like that next level. That's sort of our B's. And then the C's are ones like, hey, we're 8 figures plus. We're out of ideas how to get to that next level of scale. And that's like a C for us. And we can help each individual. But what we're seeing is more of the C's now and the B's to a certain degree. And completely counterintuitive to what you're saying right now, because we're not seeing any of that. And we've also seen the vast majority of our client base now stay with us for an even longer period of time. We've elongated our retention, and we did that sort of intentionally through 2023. We also have a lower price division of tier 11 that handles the small businesses, like the ones that you might handle, the vast majority of those folks. We're seeing them stick too, because they get a lower cost solution. So I'm not seeing what you are seeing at all. I'm seeing the exact opposite. And then I'm looking at the stock market. I mean, shit, the S&P 500 is at an all-time high right now. Like,
Yeah,
that
the problem
means
with the stock market though is I don't think it's an indication of the economy at all. It's actually it's a counterindication of people's trust in the strength of whatever the liquidity market looks like. Do you want cash or do you want a fractional share of a business? And if you don't want cash, you put it into, I mean, what other options do non-accredited investors have?
not much. I will say this is I don't look at the stock market as an indicator of the state of the economy per se. What I do look at it as, if the market is as high as it is, there's a greater degree of confidence with a certain subset of individuals that say, hey, now I have money. I feel a little bit more secure. I feel it myself. Like, I have an app that checks my net worth like every single day, and it's the highest it's ever been because of our stock portfolio. Uh, but it makes you feel a little bit more buoyant and optimistic about the future. And I think fear is a very, very important motivator and driver. And I think the small businesses, from what we've seen, are the first ones to ring the alarm bell because they're fearful. And I think that's what you're seeing right now. Is that an indication that things are going to be going south in 2024? By all indications, like, if you talk to, anyone who knows anything about economics, we're all like, yeah, we're in an interest rate lowering environment, whether it's 3 interest rate cuts or whether it's 5, depending on like the jobs report and all these other sorts of things, which indicates that we're in an expansion. Like, we're in actually a good spot. We're coming out of a soft landing. So there's really a big debate, like, where we are in our economic cycle right now. And if you Google it, you'll get like 10 different answers. I believe that we're in sort of a late cycle expansion. Like, we've actually sort of come out of a softish landing. Everyone was ripping Jerome Powell last year for all the interest rate hikes. And, all of a sudden my home equity line of credit, I'm paying like $1,500 a month in interest, whereas before I was paying like next to nothing. So that hurts. But now we're actually seeing our portfolio increase. And for me, as an individual, and I think maybe I'm more of an indication of who our ideal customer profile is at tier 11, I'm seeing a lot of optimism and not negativity.
I have a petulant statement.
You're thinking.
Well, so the problem with the financial pundits is, if any of them knew what they were talking about, they'd be billionaires.
True.
So none of that's why I don't like giving my money to financial managers. All those, the Ameriprise guys or whoever that are going to manage your funds for a percentage.
They're terrible.
Like, dude, you don't have any money. I'm not going to give my money to you. I've got, so it's anytime you read the articles and the whole, like, oh, this cycle or this whatever, if somebody's a literal billionaire, so I'll listen to the Warren Buffetts and the Peter Thiels and the Elon Musks and the people that have made billions of dollars with their money, because all three of those guys made money with money. But I can't, and I actually think this is a pretty logical statement, Ralph, and I know you're going to make fun of me. The official narrative can never be true. Because if it were, it would immediately correct itself, right? If the official narrative were true in an organic ecosystem, if you believe in Adam Smith's invisible hand, then we would all invest in the correct official narrative, which, because of supply and demand, would instantly balance out. And so there needs to be something on the periphery happening that allows for the margin that would catalyze change. Which is why anytime these guys are like, oh, soft landing, and using terms like that, speaking of fear, and in fairness, I've predicted 15 of the last 2 recessions, Ralph. So I realize that I live in that environment.
15 of the last 2 recessions.
So for me, this guy's always fallen. But dude, what's going on now? And I'm interested in the listeners. I'm interested in, if you're a Perpetual Traffic listener and you're seeing what I'm seeing, I want to know. And if you're not, I want to know too. So jump into our Telegram thread, because we'd really love to start just chatting with y'all one-on-one and getting a better sense, a better finger to the pulse. There's no real data for this. It's like this is an analogy. I'm not trying to pivot the conversation. Okay, office space is currently at 50% occupancy by lease. Have you heard this?
Yes.
Commercial office space is at 50% occupancy by lease. That means that 50% of office spaces in the United States are leased. First of all, terrifying statistic, especially when you consider that all the pension funds and REITs that hold office space, like who's at risk. Now, the thing that we can't measure of the 50% that's not leased, we know that's a measurable risk, catastrophe, right? But the 50% that's leased, how many of those are empty, just waiting for the 10-year lease to burn down?
Yeah.
It's an unknown. It's an unknowable unknown. Do you know what I mean? Like, it's one of those things that we can't even get a finger to the pulse on. And then the implications of it are staggering, because depending on the number, those leases aren't going to be renewed. And then you're looking at a collapse in the commercial office space. And they're all going to be luxury condos, right? Like, that's just the only thing that we know what to do with these buildings. So
right.
I feel like we're in a similar spot right now with the small and medium-sized business substructure, where there's, before the annual reporting is done, or before the businesses actually like take the shingle off the door and go under, what are the predictive indicators? But so we have the lease in office space is the business going under in small businesses. And I know you have some like earnings statements and things like that, but even small business earnings statements, that's a difficult, very fluid data point. It's not as trackable as a publicly traded company, for instance. Like, who's gathering this data, who's amalgamating, who's looking at it? I feel like we don't have any visibility into what's actually happening here. And then here I am, a little marketing agency, and I'm watching and I'm seeing my friends. I have two masterminds. I have Driven, but I don't know if you know this. I also have the You versus Google mastermind, which is just for media buyers. And I'm seeing all these little media buyers saying the same thing, and solid media buyers, dude, like people that actually know what the hell they're talking about. And they're like, our market is frozen up. And it's all these small little businesses that, even if they're not losing money per se, they're definitely tightening their belt. And there's got to be a reason for that. It can't just be like, if it's not in the news, where would the fear come from? They have to be seeing something too. And I have something of a theory here, but I've been talking for too long and I don't want to monopolize the conversation. So I will yield the floor for my inevitable lashing.
I'm not doubting what you're saying. All I'm saying is that I think it's interesting. Like, you might be an early indicator that I don't see. And I'm not doubting, because you're seeing what you're seeing. You're not making it up. And yes, you are Chicken Little at times. And yes, you do have an armory of guns. I've been
pretty right a couple of really important times. Like Chicken Little lived.
You'll be right.
If you remember the end of the story. Chicken Little, that chicken did not cross the road.
I forget what happened to Chicken Little.
I don't really know, but I'm going to assume that Chicken Little lived, because that would make the most sense. Like, the neurotic chicken is an alive chicken.
I think it's an important Telegram thread that we have to go. Whatever happened to Chicken Little?
What happened to Chicken Little?
Yeah.
I'm going to Google it.
The interesting part to all this is that the housing market is still like white hot in the Massachusetts area. Like, something comes on and it's gone within days. Now, nationally, all the indicators look.
Is it all selling to BlackRock?
No. It's selling to well-heeled individuals. Like, there is a have and have-nots. I think that and this is a great book. I recommended this to you. There's such a disparity in income levels in the United States. It's tragic. And there's a story of a hospital chain that I used to call on for years and years in the pharma industry. And it serves these underserved communities called Steward Healthcare. So I will leave a link in the show notes about it. And these hospitals basically don't even have enough money to pay for like gauze and, clean linens. And they're bleeding money. And this one company, I think it was Cerebrus, it's this private equity hedge fund, $1 billion, installed a new CEO, and just raped the entire healthcare system. And now they are basically teetering on the edge. Like, I know these communities, I know these doctors that are in these hospitals. And the front page news of the Boston Globe was the CEO, this guy named Ralph De La Torre, I believe his name is. He has two 20, 30, 40, $50 million yachts, and his pay package is in the hundreds of millions. And I'm like, this is just wrong. Like, I think there is a tremendous disparity between, the upper middle class now, and the inequity in pay is absolutely crazy. Like, you have people that are barely getting by. And my son actually became an economics major at Dartmouth for his first year because of this, because he wanted to figure out a way to do it. He actually wrote his essay about it. We did a lot of research on it. Point is ended up becoming an electrical engineer and following the dollars. But anyway, be that as it may, the point is
That
like
actually
there's
makes a lot of
such
sense. He went and learned how the economy works, and he's like, "Well, I need to go definitely do something."
yeah, I need to go do something else. But no, the point is that I think that disparity, which still exists to this day, and in the book that I referred to you was The Man Who Destroyed America.
Yeah,
It's the book on Jack Welch. We're gonna have to
yeah.
get
I
the
haven't read it
exact
yet, but
title.
I have it. It's on my list.
Yeah, and it talks about the disparity in pay between CEOs and the drive for earnings in publicly traded companies, and the biggest cost for them, in many cases, aside from SG&A, is cost of goods sold, personnel, and wages. And wages, even though they have been on the increase in the last year, if you do look at some
But
of
I
the
think
economic
effective
data,
wages haven't
but
actually increased in the
effective,
1970s.
yeah, effectively,
Yeah.
yes. You have this massive disparity. And I think that is one of the biggest problems here in the United States right now, is because of that disparity of wealth. Now, in tier 11, we tend to go, for more of the folks that are, not small businesses. Like I said, we have a separate division that deals with that. So we're not seeing it firsthand, but I do think that factor is something that plays into all of this. And that's pervasive. And that's been happening since Jack Welch became like rock star CEO. And then he went crazy, by the way, like before his death. Like, he went like nutso off the, like, started following Trump, and he turned into a disgusting individual. But he was always sort of out for himself. But the point is like, he destroyed corporate America, because then it changed, like, from the 50s and 60s model of a living wage, middle class. There's no middle class now. It's like there's lower middle class that are barely getting by. And yes, wages are effectively up in the last year, but still, real wages, like you said, are flat to down, which is really hard. How the hell is somebody supposed to afford an apartment in Boston? Like, where I live, it's like $3,500, $4,000. How do you do that if you're making 50 grand a year? Like, as a family, like, there's no freaking way. It's like this huge disparity has definitely happened. So I know you and I, run businesses where we have a lot of international labor, but we also overpay in that market, which we talked about in our last presentation. But so there is that part to it. That was a whole other. But I do think that pay disparity is a huge issue, and I think that might be a part of it. It's like this lurking issue that nobody really talks about much.
Can I jump on my favorite soapbox in the whole wide world, Ralph Burns?
You have a fair amount of soapboxes over there.
Oh no, this is the one.
Do you use a lot of soap?
All the soapboxes are full, because I have so many soapboxes that I don't even open them anymore. Amazon does the subscribe and save. I get my 15% off, and then I keep them in the back.
You got another soapbox. All right,
Yeah.
so let's hear it.
So I don't think it was Jack Welch. I have no doubt that the impact that he had on the corporate substructure, or whatever, had whatever ripple effect we were talking about. But the reason that we're in a situation where the middle class, and now, interestingly, even the upper middle class, can't gain a foothold, is because money's worthless. There's a really interesting website called WTF Happened in 1971.com. We'll leave a link in the show notes. In 1971, we were taken off of the international gold standard, which started the US dollar as a fiat currency. Now, we were taking off the domestic gold standard in the 30s, but that's not the same thing as being completely unhinged and unconnected from some level of backing, of material backing. And if you look at the nature of fiat currency, if any idiot can print the dollar, that means that your dollar is at the mercy of that idiot. And we have unbelievable idiots running the Fed, as evidenced by the fact that 40% of the money that is in existence was printed in the last 2.5 to 3 years. And so if you just take a person who's breaking bricks on the side of the road, that person is paid a certain amount of money for their time. It's a time for money trade. And when we had gold, and you don't have to use gold, by the way, everybody always gets all obsessive with, well, there's only so much gold and what a myopic scope. You could use whatever you want. You could use fuel, corn, land, moon rocks, some backing that is scarce, that some jackass can't just print. Salt. The Roman government used to use salt. That's where this phrase, the man is worth his salt, comes from. So if you're breaking brick on the side of the road, okay, and you give me an hour of your time to break bricks, and I'm using that analogy, by the way, because it's a job anybody can do. Not everybody can be a media buyer, an engineer, a surgeon. Not everybody can be a cab driver. Like, you have to have an economy that supports the what would you say, minimal viable standard of labor. That person, that laborer, should be able to support themselves with the sweat of their brow. They should be able to support a family of 4 if you want a functional society. They should be able to support a spouse and 2 children, 2.1 children technically, if we want to be able to grow, and we want to be able to grow. So the minute somebody else can print your dollar, I trade that person, you break bricks on the side of the road, and I give you value in exchange. Your hour for this value. Tomorrow, if the value is stable, that person made an adequate trade, because now that person can go and buy meat, bread, candles, fuel, housing, whatever, for the same amount of labor that they expelled the day before. But that's not the environment that we're in. Tomorrow, that person's hour is worth 55 minutes. The day after, it's worth 50. The day after that, it's worth 45. And you think, well, Kasim, you're being a little hyperbolic and you're exaggerating. But am I really? Am I really? Because look at, and all you need to do in order to really see this in action is look at the cost of housing. Because in 1970s, my grandma bought a house for $19,000 that's now worth $750,000. Is that house really worth $750,000? No. $750,000 is worth $19,000 in 1970. We are hemorrhaging the value of, wait for it, because this is pernicious, it's evil, it's sinful. I'm not a religious person, Ralph, but this is the only time I'll use this word sin. If you take a person's time, you're taking their life. That's time that they could have spent with their family, their loved ones, their children. How do children spell love? T-I-M-E. If you take somebody's time, you're taking their life. It's all we have. It's the only thing that humanity has equally. In the egalitarian society, we're all supposed to be equal. This is the only thing that God has given to us equally. You take a person's time, you take their life. And then to devalue that time systematically with intent, that's evil. And what it allows you, the entity that would do that, to do is financial arbitrage. How and why can people in Wall Street make hundreds of millions and billions of dollars without creating anything? They create nothing. They build nothing. They manufacture nothing. They invent nothing, but they move things from pillar to post. And because they understand the way that this works, they play with time. And because we are devaluing people's time, we're devaluing their life. So that Wall Street jackass that's making billions of dollars is trading human life. It's literal slavery. Fiat currency is literal slavery because you have to work for it. You're not allowed to trade in the United States. This is an absolute fact. You're not allowed to trade in anything other than the US dollar. Barter is technically illegal because it's non-taxable. You can't live without making US dollars because you have to pay property taxes. It's literal slavery. And we're putting people in a position to where, and this is why the middle class and even now the upper middle class can't get a foothold. Because if you can't save enough money, and this is the line of demarcation, where when you save enough money to where your investments now yield something in excess of the inflationary line, you're now on the other side of this pernicious evil. You're on the side that benefits from inflationary policy because you're able to put money in things like real estate that are not just recession or inflation proof, but they're actually they're anti-fragile as it relates to inflation, because inflation helps the value of things like real estate or corporations. Or, our producer just dropped into chat that the S&P is carried by Apple, Alphabet, Meta, Microsoft, Nvidia, Amazon, and Tesla. All of those are not just inflation proof, they're anti-fragile to inflation, because I know if I put my dollar in there, that dollar is going to be worth more tomorrow than it is today. Whereas my dollar today is going to always be worth less because we have a fiat currency. When we print money, we steal time. And it's printing money that steals from the middle class and the lower middle class, because all they have to trade is time. They don't have the assets necessary to get themselves out ahead of inflation. So if we really wanted to fix this, we would have a commodity-backed currency. And that commodity could be anything. It doesn't have to be the gold standard. I'm not going Ron Paul on you. It could be land, oil, fuel, broadband internet, whatever you want to talk about. But a fiat currency is the most pervasive and pernicious evil in the civilized world. And the fact that we allow it to exist is an open air conspiracy. Like we all know it. I mean, your son was an economics major for a year. Go talk to him about the Fed. Why is it that an independent entity can print our freaking money at will anytime they want to, and then do what with it? Like, a person traded their life for this government-backed representation of value, and then some jackass can just print it and then give it to other private entities to lend back to us at interest? Did you know there's more money owed than exists? Because for every dollar printed, we have to pay interest on that dollar. So if a dollar is printed and there's 10% interest due, then there's $1.10 due. It's a forced obsolescence is built into the system, and we just let it happen. Anyway, sorry, soapbox over.
So your solution, if Kasim was in charge,
commodity-backed currency, and first of all, and the Fed. Why is it that the only founding father that has a Broadway play dedicated to him is the guy that created the Federal Reserve? Like, Alexander Hamilton was a traitor, and he knew what he was doing. That's the worst part. Andrew Jackson took the presidency just to kill the Fed. So the answer is end the Fed, put those guys in prison for treacherous, anti-U.S., whatever you want to call it, and then have a commodity-backed currency. And the commodity, nobody should talk to me about gold. I don't care about gold. The commodity can be anything. It could be a mixture of things. We're now, with tokenization and the insane plethora of value-backed commodities, you could have a multivariant mixed commodity-backed currency. But you have to have a commodity-backed currency. You have to have a currency that will always be of some value, that's scarce. When you can just print value, dude, it's literally like I can just go to my printer and say, okay, here's another $100 million.
Mm.
How could that possibly function in real life? It's insane.
Well, I mean, the gold standard was flawed because there's a finite amount of gold. Like,
well, no, that's the
we're talking about what we're talking about.
You could run the entire global economy on 1 ounce of gold, because all you would do is just continue to fractionalize the gold. The point is
the gold.
Now, what you do have, and
what's the value of that gold, though? I mean, obviously, that's a commodity unto itself. It's going to fluctuate with the markets.
Sure, and it has to be innately valuable too. That's why the Romans liked salt, because salt was a preservative and allowed you to keep food, which was really, really important to be able to do at the time. The counter argument to what I'm saying is that it slows growth, which is true. So when you're allowed fiat currency, you can have explosive economic growth. When you have commodity-backed currency, it will always slow growth. But isn't that what we want and need? Slow, steady, honest growth. That's why we have these, every 7 years, crash, crash. It's because this is an absolutely unsustainable model. And we're just borrowing from the future. Look at the debt. Now, the debt's actually, interestingly, because of fiat currency, first of all, 60% of the US dollar is owned by foreign forces. So they eat our inflation, which is also pernicious because we force them to use the dollar because they have to buy oil and dollar, and fuel is the most important thing to economy, second most important to confidence, but the most important tangible thing. But dude, it's unreal that this is allowed to happen, and smart people know what's happening and nobody says anything. Nobody says anything. We just live in this world. It's crazy. Blows me away. Pisses me off.
Well, we're gonna leave all links in the show notes. The website that you mentioned here, in the interest of time, WTF happened in 1971 is amazing, and Jack Welch came into power in the late 70s. By
I
the way,
looked that up too. I was like,
yeah,
what's the crossover
yeah,
here? Yeah.
there is some crossover. I think it
Yeah.
probably added fuel to the fire to a certain degree. And I'm not saying GE was the one that did it, but if you read this book and you actually see what happened, GE's methodology of how to manage in this disparity in wealth, exacerbated by, whether or not it was 1971 and the Bretton Woods Conference, which we've been to, of course. There's a museum there.
Of course.
Of course we have, because we've been to every presidential museum in history. Why not the one that's actually in New Hampshire? When we came off the gold standard, the point is I think this added fuel to it. And that still is a huge issue today, which might be the reason why when we started today's recording, we're starting to see some early warning signs in the lower market. And when I say lower market, I'm not saying that degradingly. I'm saying that just as smaller businesses,
Smaller markets. Yeah.
smaller markets, that's where you see it. So we're going to leave all links in the show notes here.
We had one link, Ralph. The link is The Creature from Jekyll Island. If somebody really wants to dive into the Fed and what it is, go read The Creature from Jekyll. It's fascinating.
All right. Well, definitely check out perpetualtraffic.com. We're going to leave links in the show notes for this one. Yes, we went very high level here, a little bit on the rant side. Whether you agree with us or not, that's the important part to this, is that we want to have a healthy debate and a healthy conversation with you, the listener, as well as how this relates back to marketing. This, at the end of the day, this is a marketing podcast, but marketing is the means in which to drive business, everyone. It's not marketing for its own sake. It's a means to an end. We just happen to do it through marketing agencies ourselves, between Kasim and myself. But check out our Telegram over at perpetualtraffic.com/Telegram. Of course, subscribe to our YouTube channel. That's perpetualtraffic.com/YouTube. All the links that we mentioned here and all the resources are in the show notes over at perpetualtraffic.com. So please interact with us on Telegram. Leave a rating wherever you listen to podcasts. Give us some ratings over on Spotify. And on behalf of my awesome co-host, Kasim Aslam, peace. Until next show, see ya.